Hello, everyone. Thank you for joining us today for our June conference. And today we'll be talking about selling, buying companies, or taking investors in to your company. How can you do that? Or even where should you be investing in today? I'm doing a few things. I'm letting people join us. There's quite a few of you joining right now. And as we have a lot to cover today with Brooke, Margot, and Jacobie. And so we'll already get started and introduce everyone. And yeah, that's it. And so, so we'll be recording this session, but do stay until the end because not only it's great content, but there's Q&A in the end. So if you have a pressing question about selling, buying, investing, you really want to talk to our experts today. So without further ado, because I don't want to be standing between you and the value being delivered today, I'm going to be presenting this, and at the same time, I'm going to be keeping inviting people. So bear with me. It's just me today doing everything. We should be good, but I want to make sure people can really attend the meeting. All right. Right. So today for this conference, can you guys see my slides well?
Yes.
Yes.
Okay. I would stay in non-presentation mode because it's just easier so I can keep admitting people and making sure everything's on track. All right. With C2G Advisors, Hostfully, and Vintory, we are presenting today this conference called Money Matters, Selling, Buying, Raising Money in the vacation rental industry. We'll be talking a lot about the vacation rental management companies, but as well as we're covering as well vacation rental tech companies. That's going to be quite interesting. The topics we're covering today, we'll be talking, for example, we hear lots about the casa and VTrips buying up companies, but that's not just what there is here. And we'll go through how what the investment landscape is like. Then we'll be talking about prepping your company, right? How do you put your house in order before opening the door to investors? We did mention Vacasa, and they have quite interesting playbook. So what to learn from that? Then we'll be talking about where to invest in 2022, and then where to find buyers, sellers, investors. And also we'll be touching upon crowdfunding, which is actually an interesting path that some companies have taken. All right, so for the intro, I'm Thibault. I'm the founder of Rental Scale Up. As you may know, Rental Scale Up, we do two things. We publish news about the vacation rental industry. We have a free newsletter to sign up to that, rentalscale.com/newsletter. And we do consulting for vacation rental tech companies, from product management to product marketing. That was my spiel. But most important here today, we have Jacobie Olin from C2G Advisors, Margot Schmorak from Hostfully, and Brooke Pfautz from Vintory. I will love that each of you, starting with Jacobie, introduce themselves and tell us a bit more about who you are, what you do, and what makes you a great speaker for today's session.
Sure. Thank you, Thibault. My name is Jacobie Olin, and I'm the president of C2G Advisors. We are a consulting and M&A advisory firm, specifically here in the short-term vacation rental industry. We do buy-sell transactions for property management companies and technology providers. Last year, we completed around 20 deals for around $200 million. And knock on wood, we're on pace to surpass that this year. And I'm just happy to be a part of this panel.
Thank you, Jacobie. Margot, do you want to take it away?
Yeah, hi everybody. My name is Margot. I am coming to you from San Francisco. I am the CEO and co-founder of Hostfully. We are a company that makes software for property managers. We make a digital guidebooks product and our property management platform, which helps you distribute your listings across multiple bookings platforms like channel management, including Airbnb, Booking.com, and Vrbo, and do a lot of other great stuff in your business like automate messages and payments and stuff like that. I'm here today on this panel, though, because I'm bringing the startup perspective. As the CEO of Hostfully, I've raised $7 million for the company over the history of the company. Most recently, we closed a $4 million equity seed financing round, and now we have over 60 people on the team, and we just have like a more mature organization. So I've learned a lot on the way here. One other note is on my background is I was at another company called Service Source right after they IPO'd. So I've had kind of the experience of being on a company at a company that had just gone public. And then we also at Hostfully did a merger with Orbi Rental, which at the time was a property management software company. Now they're both under the umbrella of Hostfully. And so I do have the perspective of two early stage companies figuring out how to do M&A together. So I'm excited to bring some of that perspective to this conversation. Thank you.
Thank you, Margot. Brooke, how about you?
Yeah, well, thank you. Excited to be here. My name is Brooke Pfautz. I'm founder and CEO of Vintory. Vintory is a sales and marketing platform that helps short-term vacation rental managers grow their inventory. So all we're focused on exclusively is on the supply side and helping professional short-term vacation rental managers add more homeowners to their rental program. We don't do anything with guests. We're not doing anything with operations. We focus exclusively on the supply side. One little kind of tidbit about me and my background, kind of what makes me be able to speak at this panel is I actually grew my professional vacation rental management company. I started in Ocean City, Maryland, grew it from 0 to 500 properties in 5 years, exited that company. So I've got some experience with growing companies and then also selling companies. And then also now at Vintory, we've helped well over 300 companies actually with their growth efforts. So we get to see in large scale, in aggregate across the entire United States, kind of what's working, what's not working as far as inventory acquisition. And super excited to be here.
Thank you, Brooke. Thank you, Margot and Jacobie, and thank you everyone for attending. Let me also, speaking of thanks, let me also, before we go right into the first topic, share something with you guys attending. As promised, when you sign up, we have 3 offers for you from 3 companies attending here. And you get the ways to redeem the offers in a follow-up email. But just so you know, right, C2G Advisors is offering you a free business evaluation. It's like done for you, basically, evaluation of your vacation rental business, which is crucial, obviously, if you want to start a company. Hostfully on their side is waiving the onboarding fees. That's a $400 value if you sign up for their monthly plan. As for Vintory has a bunch of things for you from a gift card to access to their product. With, I think, correct me if I'm wrong, Brooke here, a free landing page, there's a free book, and people have access for a certain time to even homeowner data to understand the breadth of your solution.
Correct. Right.
So again, thank you for speakers for providing this. Without further ado, first topic. So it looks like, whenever you look at the Rentals Club website, for example, so I'm guilty of that, maybe, that whenever we're talking about the industry, it seems like, Vacasa is buying up another company, or Steve Milo is busy saying that he's buying other companies too. So is it just Vacasa and VTrips? I don't think so, right? When I say this, there's obviously lots of things happening in industry, big titles, but of course there's also vacation tech companies raising money here. So what's really landscape like? And so without further ado, I would love to hear you guys talk about this. Is it just in the end just Vacasa and VTrips? So how is it? Maybe Brooke, do you want to get started?
Yeah, I mean, I think it's almost like an iceberg metaphor, really. I mean, if you think about it, it seems like if you just kind of listen to the headlines, it's only VTrips and Vacasa out there that are acquiring companies, but there are many, many, many companies out there that are picking up and consolidating these short-term vacation rental management companies. And honestly, a lot of them are doing it very quietly under the radar. I actually had breakfast this morning with one of them, and he's acquired, I think, close to a dozen companies, and I don't think they've put out one press release yet on one of those acquisitions. So they're doing it, they're flying under the radar. And we are actually, it seems like every conference I go to, it seems like I meet a new private equity company that's out there that's looking to roll up and consolidate some of these property managers.
Well, thanks, Brooke. I need to know about this. If any press release in the article, I need to cover that on rental scale-up. Jacobie, so how about you? Because Brooke did mention these deals under the radar, and obviously you are the radar. So tell us more about this.
Thank you, and Brooke is 100% correct. There is there's a wide array of buyer demographics right now, and so you have on one end of the spectrum more of like the VC backed going towards the public markets and or already public companies, and those are the ones that are doing the press releases and that are a little bit louder about their fundraising and or their acquisitions, because as they become public companies, their shareholders are the public, so keeping them updated with how they're growing and stuff of that nature. So that's typically where we all as just industry people see these large headlines and stuff of that nature. And then on the other end of the spectrum, as Brooke mentioned, are the more quieter ones. These are more the institutional funds, the private equity groups, the family offices, some of those strategic acquirers, and they're more brand light or brand agnostic, and they're out there trolling just as much as some of the more VC-backed ones, and so it is a very interesting time to be a seller right now. That you can kind of look at what's more important to you, and try to find a buyer that is aligned with some of your cultures, philosophies, your brand, and stuff of that nature.
Mm-hmm.
And so we're talking here obviously about property management companies, but I think, Margot, is sort of the same thing with vacation rental tech, right? You also have like these big Vacasas of the world, these big deals you hear about. There's quite a few or so smaller deals happening that we don't really hear about.
Mm-hmm. Yeah, so on the software side, we're seeing a lot of movement in general, and I think it's coming from a bunch of factors. Like number one, I think people feel like the dust has settled from COVID, and so they feel comfortable investing in this market, in that it's in travel. Number two, this is a totally new market that people don't understand very well. And actually, Jacobie and Brooke and I were joking about how like no one really has the definitive answer on how big this market is or how fast it's growing. But in this market today, like what's the date? June 30th of 2022, this market is extremely attractive. It's still growing, it's healthy, it has a lot of like runway to go. And I think that it's been proven out by Airbnb largely, but also just people's own personal experiences of wanting to stay in a vacation rental. And so we're seeing a lot of activity, not just on the property manager side, but also on the software side. And you've got deals like, Guessy buying Your Porter and My VR, and other software roll-ups like Inhabit IQ. I don't have a lot of details on those, but just those are some examples. And so basically from an investor's perspective, there's a lot of curiosity and interest in our market. And I personally get, like 2 to 3 inbound a day from investors, and most 99.9 of them are not appropriate for whatever would never be appropriate for me. We're not raising right now, but even if we were. So there's just a lot of like curiosity, because I think the other parts of the market are so much weaker, so that this part of the market stands out as being a really strong performer. It's great for everyone who's in the room today. Honestly, it's good news.
Thank you, Margot. So let's imagine, indeed, I'm in the room right now, and I think I do want maybe to sell my company or to take investors in. And I think Jacobie always had this great expression about this, what to do before even thinking about inviting people in or selling your business is getting your house in order. So maybe Jacobie, can you explain to us what you mean by that and what people should actually be doing to get ready for example, selling the company?
Yeah, sure. And thank you for bringing that up. We have so many times we have sellers come up to us a month to 3 months out from when they're ready to sell. And they're like, please clean us up and let's go to market. And obviously we can only do what we can do at that juncture. So we always try to push, like, proactively prepare your company to sell, do stuff on the front end, always having that exit in mind a year, 2 years, 3 years out. And a couple of things internally that you can do with your company is staffing is always a large component. So there's obviously, we can go deep in that, but just 2 of the things to think about there is hire an owner relations person or an owner relations team, and then also hire a GM or director of ops or whatever you want to call that. So the more that you can kind of remove yourself from those types of roles, the better that's going to look for you for at least two reasons. And one will be, you will likely have less contingencies on the structure of the deal that the buyer offers. And then also the longevity of the transition that you have to work post-close will likely be a little bit less. So focusing on those on the front end is always a huge component. Now, next, another one to focus on are your contracts. Most of these deals are asset-based deals, and the assets, the real assets of these industries are these management contracts with the homeowners. So especially if you have a company that's 10 years old, you might have 25 different versions of your management contracts. So trying to standardize those as much as possible will only help you during that process. And a couple of terms there, the assignability clause, that is a must-have in these contracts. We've had deals almost fall apart because certain contracts weren't assignable, and we had to get written consent from the homeowner, which was not a fun time. And then an auto renewal clause, and just having something in some type of hook in the contracts that a homeowner can't just like leave on a whim if they're not happy from a weekend of like guests destroying the home or something of that nature. Another thing that buyers, this is one of the most important things buyers are looking at, is the company growing unit count, remaining stagnant, or losing unit count? The unit qualifier is paramount in these deals. So proactively having an approach showing that your unit count is going up and to the right year over year over year is honestly the best thing you can do in terms of looking the best for these potential buyers. And fortunately for all of us on this conference, we have an incredible individual that created an incredible company called Vintory that will specifically help you do that. So honestly, focus on that on the front end years out from selling. And then lastly, kind of the financials. Those are obviously super important. We've had a couple of deals fall apart this year because the seller just didn't understand what their profitability was. And when we got deeper down the road, they were portraying something that was not honestly true. And a lot of these buyers today they're going to do this thing called a QOB, a quality of earnings during due diligence. So if your financials are not your strong suit, then hire out a bookkeeper or accountant to do monthly reconciliations because that is a necessity. In terms of kind of more macro approach there, research multiples and structures and buyers in the industry and other small and medium-sized business markets. There's a lot of articles, blog posts, people speak at conferences and podcasts where people talk about these things. So you can get realistic pricing expectations on the front end to see if, hey, I might fall in this range. This is what sounds good to me to sell. Or like, hey, I want to get X amount higher. Let me work towards getting there. And then lastly, talk to advisors. Not just C2G advisors, talk to an accountant, a transactional based accountant to understand the tax effects from doing a deal, from an asset versus stock deal, from closing a deal in 2022 versus closing a deal in 2023, from what if you roll over equity into the buying partner? Is it deferred taxes? Most deals are not going to be all cash at closing. So if they put 50% down at closing, does the other 50% pay the next year or the year after that? How is that going to affect you? And then lastly is a financial advisor to talk to, or a wealth advisor, because you might be 60 or you might be 30 when you're selling your company, and you need to understand kind of what's next for you. Are you setting up for your family to be secure, or are you looking at rolling this money into a new venture?
Wow, this conference is such a value bomb. Thanks a lot. And for people joining, thank you, Jacobie. For people joining, obviously we're recording this one, so if you missed the beginning, you get access to it in a follow-up email. But do stay until the end, because we will start the Q&A right in the end, so you can start dropping your questions, by the way, if you want to, in the chat. But so we talk here about preparing, getting your house in order for your, for example, if you going you're on a selling company, but Margot, I'm curious, if you are going to go the investment M&A route, what does it look like?
Yeah, it's really similar, honestly. I think those are all really great points. And one of the key things that Jacobie said is that for property management, M&A is typically an asset-based transaction. And for software, it's a little bit different because I'm thinking also about differentiation and, if there's anything different in my business that anybody else doesn't offer out there. So it's a little bit of a different kind of profile. But the notes on financials, I can't emphasize enough. It's kind of like unless you are or you have been a CFO and you've gone through basically bringing a company public from nothing, you have no idea what you're doing. And you might have been, in finance or seen financial models along the way, like spot checks, but it's really where the sausage gets made in the business. And I'm so grateful to our board member, Olin, actually for pushing us to get our financials in a much more mature state than we were actually wanting to do. And it positioned us so well to do our fundraise. We went out at the end of last year. It was kind of at the end of the big wave of financings, and we were able to get that nice big round closed, even when things were sort of falling apart. And this has actually happened a couple times for us. We also raised in the beginning of COVID, literally when the world was shutting down and everybody thought that travel was going to finish forever. And a lot of that had to do with just having things really, really organized. Because at the end of the day, we're creating value with a team of people, or with assets, whether it's software or with rentals. And if you can't demonstrate that in the numbers, then you just won't be able to get the deal done. So I think that is the number one kind of double click that you should take away from this session, actually, which is that if you don't have a financial advisor who really knows their stuff, go find one, because that has been a huge game changer for us.
Thanks. I really like the on the ground real life experience here that you are sharing here, Margot. And I think somebody else got real life experience also in here is Brooke, because I think you did exit your company, right? You did sell your own company. And so when you hear this expression, getting your house in order, what was it like for you? Or what do you tell, people, friends asking you the question?
Yeah, well, first off, Jacobie and Margot just nailed it absolutely perfect. So I don't have a ton to add. The biggest thing is, again, they really do, I think Jacobie kind of ended on this, and it's true. They do want to see that inventory growth going up and to the right. If it's stagnant or flat, obviously you're going to get a smaller multiple. If it's going up, it's going to be obviously a much greater multiple, because there's just, you have that inventory growth going on. But also, what we've seen from some of the companies that we've worked with, and in my experience too, is just if you have that solid go-to-market strategy in place, where you have this system of signing up new properties. So you've got the marketing machine going on, and obviously it's great if it's organic. You have the business development reps that are closing those deals. You've got a really efficient onboarding process. That's only going to improve kind of that multiple. But again, what these two just said kind of nailed it perfectly. So I can't add too much when they nailed it perfectly.
Okay, Brooke, thanks for doing this, but I will keep you on the hook here, because I'm going to show something now, which is what we call the Vacasa playbook, right? Which is basically how Vacasa, what Vacasa told to the market on how they would be growing. So let me just share that. And Brooke, I will actually ask you to start commenting on this one. Let me just show it so I can quickly introduce it as well. I think, can you guys see it?
Yes. Okay,
it was perfect. Again, that's a slide that Vacasa shared last year when they were raising money, basically. Basically they were talking to investors, let's say that this way. And they were showing basically they had two ways to grow, right? What they call their individual strategy, which is to go after homeowners, one after the other, one at a time. And I think that's the model you know pretty well, Brooke, because that's what your company Vintory does. And the other part of their growth strategy is portfolio, which they've really been honestly known for, which is acquiring other companies. And that's, again, Jacobie, this bit pretty well. And that's normally what they said this year. Normally, 1/4 of the growth this year should have been from this portfolio acquisition strategy, and 3/4, which is normal, it's big, from acquiring individual homes. So when you see this, Brooke, what do you think of this Vacasa playbook? Is it something that we can learn? Is there anything we can learn from this, or is just Vacasa specific?
Well, there's so much to talk about on this slide, and I absolutely love it. And anybody that hasn't read the Vacasa investor deck from last July, I highly recommend you do it. You can just Google it and you can download it. It's fantastic. There's an absolute treasure trove of information in that slide deck that they disclosed. But as you pointed out, they said that 75% of their growth they're anticipating in the future is going organically versus what they call corporate development or M&A, which I actually found very surprising, because I think to date it seems almost inverse of that. It seems like most of their acquisitions have actually been more heavily loaded on the corp dev or the M&A side of things. But there's a couple reasons why. First off, there aren't any really big, large companies out there to acquire. Obviously, there's companies, 100 property managers, 100 properties, 200, 300, or 50. But the Wyndhams of the world, the turnkeys of the world are all gone, at least in the U.S. So they've kind of eliminated that. So, but I think what they've recognized too is there's a couple reasons why they've probably focused more on the organic growth side than in the M&A. The first is it's much cheaper to acquire. If you read that investor deck, their CAC, and if you don't know what CAC stands for, it's customer acquisition cost. Their CAC for organic growth is $6,700 a property. What they said in their investor deck was they're on acquisition, they're paying $21,000 a property. So it's about a third of the cost to actually acquire it organically than on an M&A basis. But also what we've seen is the churn, what percentage of the inventory they lose after acquisition, is significantly higher on a M&A basis. I mean, I've heard stories as much as 30, and I have no data to back this up, but I've heard stories as much as 30 to 50% of churn on some of the inventory that's happening on an M&A basis. And I think their overall churn is about a 22% if you take into account acquisitions and organic. But we're seeing traditionally in the market across 300 some partners, we see churn anywhere between 10 and 15% is more of average, out there. So again, you're going to have a lot lower churn if you do it on an organic basis. And again, it's going to be much cheaper. But one just note, I guess, that I thought interesting from with Vacasa, and if you looked at their last, I guess it was Q1 quarterly results, and they commented that their churn, they have about 37,000 properties, but they're churning 22,000 property, or 22% of their inventory. That's the equivalent of roughly 8,000 units that they have to acquire just to stay stagnant, just to keep even on where they were. I mean, that's the equivalent of acquiring a Wyndham. And again, as I said before, there aren't really any Wyndhams left out there. So but again, it's very obvious that Vacasa is going all in on the organic growth strategy and kind of that omni-channel marketing approach, similar to what Vintory does.
See, Jacobie, on your side, what do you think of the Vacasa playbook? And here really, so as well, the idea is to say, if I'm selling, should I, be, sending an email to, hey, Vacasa, just acquire me, or what should we think of that as on the acquisition side?
Yeah, and Brooke brought up a lot of good points and data, and I always love hearing him kind of break things down to the granular level, which is great. But yeah, it looks like what they're focusing on is a mixture of organic and inorganic, which is what pretty much any growing property manager should be focusing on, both of those. But in our industry, which is unique, is that when you're growing organically, you're growing one homeowner at a time. Now we're getting into some cool business models where you can partner with developers and grow 100 units, stuff like that. But typically you're just growing one homeowner at a time. So if you want to get scale or grow quickly, then you have to go inorganic, and it can be 3, 4, 5, 6. We've seen 10x the cost to grow inorganically compared to organically. So all of those numbers kind of ring true and make sense. There obviously is going to be more churn or attrition if you're doing M&As. Every deal is extremely nuanced, where some might have quite a bit of attrition and some might have zero, and some of these companies can even grow with. But kind of going back to would they be a good buyer or partner? And that goes back to my first thing, and it's ultimately the seller's decision there. Like ABC Vacation rentals might be the perfect seller to Vacasa, but XYZ vacation rentals might be the perfect seller to Village and everywhere in between. What you'll see with some of these VC-backed companies is most every deal is going to have a structure component where it'll be X amount cash at closing and X amount paid either at conversion or retention. And with these VC-backed ones or public company ones, they focus more on a conversion component because they're trying to grow a national brand. So at closing, the seller and the buyer will work on a collaborative communication with the homeowners to try to convert those contracts to the buyer's contracts. And some percentage of the purchase price might be tied to that. Whereas on the retention component, where this is more of the private equity family offices one, they might not do a conversion. The seller assigns the contracts at closing, but then they'll have a retention contingency in there where those contracts, those homeowners must remain on the program for 6 months to 2 years post-closing. So ultimately, whatever the seller is more comfortable with, and there's pros and cons to both, that's what we're seeing with kind of the different buyers out there.
All right, thanks both Brooke and Jacobie for sharing this about what's to learn about Vacasa again. And there's in the chat there's like 2 links being shared, one from Rental Scale Up, and I think another one to the actual deck. So thanks to Chris Taylor for sharing this. Now we'll talk about the 4th topic of the day, which is basically where to invest in 2022. And what I mean by where to invest is twofold, basically. Right? First one is maybe with Brooke and Jacobie talking about if I want maybe to buy a company, or where should I be buying, which markets, for example, or if I want to increase the value of my company, where should I be investing, which markets to go to. And something I want to start with, though, with Margot is as well as like, if I do want to increase, for example, again, the value of my company, right? Or what are things that people may not think of, which are important to invest in first to actually also grow or as a company?
Yeah, I think so. The first thing is to kind of understand the landscape of investors, and I'm going to try to get this done in a couple minutes here. But if you haven't thought about this, it's definitely something that you should spend a couple hours figuring out. So there's different types of investors out there. There's what's called like friends, family, and fools. Those are like the people that you know really well, who you might get to just like put money into your business. They probably won't have a specific return that they need. You should definitely tell them that it's high risk, because most investments like this are high risk, and they're probably your friends or family. And then there's the second group, which is the angel investors. And those are people that you don't know, but they're individual investors, and they have like different reasons for investing. Some people invest because they're passionate about an idea. They're passionate about a type of person running a company. They're passionate about the area that you might live in. And those people, that kind of is like wild card cowboy investors. And I think it's just important to know who they are. I would also put angel groups in that category as well. And then you have what's called institutional investors, and those are investors who are investing on behalf of other people. So they have what's called limited partners, or LPs, that are putting money into a big pool, and then that money is going to be deployed into different companies and will hopefully get a return. And there are different strategies. If you have a $100 million fund, you can invest it in 100 companies, or you can invest it in one company. And it's really important for you to understand what the intention of the fund is when you're talking to an investor. Like when I talk to anybody, I mean, these days, VC and PE, people used to say venture capital and private equity, totally different. But in my personal experience in the last year, they've really blended, and there's this gray zone of kind of growth equity in the middle. And it's really, really important to understand what the intentions of the investor are in investing in companies. And sometimes it takes like 3 or 4 questions. You can't just ask that, because they won't give you the answer very willingly usually. So I'll ask other questions like, can you tell me the size of your fund? Can you tell me like the timeline that your fund is on? Can you tell me the approximate number of companies that you're going to be investing in? Can you tell me about some successful investments that you've had? Can you tell me about some investments that have not worked out very well? Why? Right? And like, those are all questions that you should be asking investors when you're talking to them. I know this wasn't answering your original question about building value, but I just think like that is like my main point here, is that know your investor. And then once you you kind of have that picture in mind. Then you also need to have your own picture in mind, which is like, what new things am I going to be bringing to the market with this company? Is it about technology innovation? That's what it is at Hostfully, for example. Or is it about like a specific region that I'm operating in that nobody else can do very well because I have better relationships and better, a better inventory in that region, and I know how to do business there better. Those are all really different. And I think knowing that about yourself and then knowing what that means for your growth is really important too. So does that mean you have a company that's growing, that's not growing? Maybe it's growing 50% year over year, maybe it's doubling, maybe it's quadrupling year over year. Like knowing where you sit in that kind of like overall profile of your business kind of gives you a sense of like, okay, like my identity is here. And honestly, it's just the same as dating. It's like, what are my goals in life? And then how does it match up with the person that I might be partnering with? It's the same thing. So you figure out like who you are as a business, what your goals are for growth usually, and that will put you in the kind of category of investor that you want to be talking to. And then you kind of can vet out the investors as you're talking to them. I think a lot of great things have been mentioned here. I love the idea of setting up like an owner management team. I think that's actually quite overlooked in the vacation rental industry for property managers. On the software side, for our big differentiator, which investors don't love to hear because it's very hard to measure in a very precise way specifically, it's really about culture. So what I care about is having a great culture with team members and customers who are motivated to work with us. And I have this hypothesis with Hostfully that if you bring people together and you give them a transparent view of the mission of the company and you help them feel like they are an owner, which they are in the business, then they will do the best work for you. They will probably not want to be paid as much as they will need to be paid at another company. They will create a great work environment. It'll be a great community and it will be a great place to work for everybody, including me. So that's kind of my angle, which is a little bit different from the way most companies have been run in the past. And I'm really passionate about trying this out at Hostfully, and it's working really well. But for whatever your company is leaning into, like I'm a big believer also of like leaning into your strengths. So whether it's like we're a company that's growing really fast, or we're a company that has the most efficient operations, or we're a company that knows how to like get things done in the most automated way, whatever it is for your company, like lean into that strength, figure out your growth, and then you can match yourself with investors.
Thanks, Margot. It's really interesting to hear how it's been working, how successful it's made Hostfully actually. This philosophy, this way of looking at things. So still speaking about growth, and maybe here for Brooke, this one, it's like, again, let's imagine that I want maybe to grow by acquiring a company in a certain market, right? Where should I go? Or maybe I want to grow I want to enter a new market before selling because I want to enter a market that's growing fast, and next year I will think about selling my company. So how should I think about entering some markets, for example? What are good ways to look at them?
Yeah, and it's a little bit counterintuitive, and I've always been a little bit of a contrarian. This kind of just kind of helps confirm my contrarian tendencies, but. What we've seen, again, having over 300 companies, out there that are growing, we get to see, month over month how they're growing. The companies that are growing the fastest are not in these like go-to markets. It's not the Vail and the Hilton Head and the Breckenridge and the Aspens and the Outer Banks. The markets that are growing the fastest are these, like, call it B or C, markets that are non-traditional. These are markets like, Asheville, North Carolina, Texas Hill Country, Arkansas, even Berkshires, West Virginia. Like, these are the markets that are just absolutely scaling super fast. There's not a lot of competition. There's still people that are traveling to these markets, and there's just a lot of low-hanging fruit. So one of my favorite books is Blue Ocean Strategy, and it just talks about, in a summary, it's like, go kind of create a business model where the competition doesn't exist. And that's really what a lot of these companies are doing, and just scaling super fast. And I would much rather do that. If I were launching a company right now, I would literally just focus on B and C markets as opposed to the tried and true, traditional markets.
That's very interesting, because if you're looking at the websites, the data companies, for example, when they share rankings of the top markets, you're going to find the big names you mentioned, not the smaller names you mentioned here. That's very interesting. And again, here, this question I think is relevant for what we're talking about today, because maybe if I'm selling my company and I'm in one of those areas, there's something I should know about that I'm highly desirable actually, and maybe try to think how it can spin this. Or same thing, if I want to acquire a company, understanding how the market is structured is also very important. Jacobie now I talk about how the markets are important, and Brooke referred a lot to traditional vacation rental markets. We always have this divide, like urban versus traditional vacation rental markets. Again, what does it look like in terms of, like, should you go into urban markets nowadays? What do you think?
Yeah, and that's a great question, and Brooke, that was a great point about those kind of tertiary markets. And Margot, that was very enlightening listening to you. I very much enjoyed that. In terms of kind of urban versus leisure, it is interesting. As Brooke mentioned, some of those more traditional leisure markets, they might have more available inventory for someone looking to get in. So like the Gulf Coast of Florida has like 50,000 available second homes that you can get into, but the competition is also insanely fierce. And we're starting to see in those more traditional leisure markets, the RevPARs year over year decrease a little bit on same store sales. So like one home 2022 versus 2021. However, in these tertiary markets, like Brooke mentioned, and then in some of these more urban markets, like the leisure ones, the business leisure, so like Nashville, Savannah, New Orleans, Austin, markets like those, we are seeing increases in RevPAR, same store sales year over year. With those more urban markets as well, you're going to have less seasonality. So your cash flows are going to be a little bit more smoother over a 12-month period. Whereas in these, let's call it a beach market, their peak season will be from Memorial Day to Labor Day. So super high revenues and profits. But then after Labor Day, you're holding on for dear life on your reserves until the next peak season. So if you're an investor a little bit worried about some of those, the cash flow issues, urban markets might be more important to you. On the flip side of that, urban markets are going through a lot more regulations. Everyone's going through regulations right now. And this is something that we always need to be talking about. And we could spend an entire day talking about this. But if you're looking at getting into an urban market, I live in Nashville, Tennessee. Here, do a ton of research on the couple of urban markets you're looking at. Look what's on the ballot for the new ordinances. Find out who those local advocacy groups are and talk to them and understand what those regulations are, because we need to be having collaborative communications with the local municipalities. There are also national organizations like VRMA and Rent Responsibly that are focusing on helping with these local advocacy groups. So that brings in a new dynamic that's not seen in as many leisure markets. And so you'll just want to do your research on there, because it might be capped at a maximum number of short-term rentals. It might be capped at bedroom count. It might be capped on certain zoning requirements and all of that fun stuff. Also, there is typically a different guest demographic from urban versus leisure. And granted, I'm talking in generalities, but leisure is more traditionally these group family travels. Whereas in some of these leisure urban areas, it'll be more skewed either towards business, or in some of these more markets like Nashville or New Orleans, I mean, it can be skewed towards partiers. And they might treat the houses a little bit differently, the guests might, than some of the families. So just understanding all of that stuff is always very important. In terms of what is more attractive to buyers currently, they're more interested in leisure markets right now. Just frankly, it is what it is with that. And likely most of that is the regulatory environment.
Regulations, always a fun topic. I know we hate discussing this, but it's so important. Thanks for mentioning that and how they are.
Yeah, just one more note, and I don't want to get too much into advocacy either, but I think there's a good case for looking at the maturity of the regulations in the areas that you're thinking about investing in. So it's not just like like, yes, you can have these like dramatic, caps or like one-time kind of like moments in the way that regulations get created, but understanding like whether it's completely I think the biggest risk areas are actually the areas that are completely unregulated. Like if I were investing, I would invest in an area where regulation has been kind of gone through the pendulum of going back and forth of being maybe too harsh and then maybe being a little, or maybe starting out, with no regulation and being too harsh and kind of heading towards the middle. Then I would invest in an area that just doesn't have anything at all, because what we've seen is that there's like this kind of swing one way or the other with regulation. So just like knowing, how many people on the city council have been thinking about this topic for how many years is like a really good question to ask yourself.
It is a great question. Love that.
Yeah.
Love that. And we just mentioned a lot of like, if you're buying, if you're selling, or we talked about as well as like investors and things. And I think for the last part of our conference today, people may be wondering, okay, that's great, but where do I find these people? And Margot, you did a great job summarizing the different types of investors out there, right? But how do you contact them? Or even, for example, we talk about topics like fundraising, crowdfunding, how do these things work? I know it's hard to do in 3 minutes, but how should we even think about this to get started? How do I get started with that?
Well, I have one, well, first of all, it's a numbers game. So like the more investors you can get in front of, the better, and the better deal you're going to get for yourself. So like, just be prepared to have the same stupid meeting over and over again, have some of them go terribly, or, either on your side, or you're like, this person is totally not a great fit for me. But I think that the thing that I've learned is that you don't really gain a lot from being keeping your cards too close to your chest. When I started Hostfully, I thought it was like a big deal to like kind of stay secretive and more vague about what was going inside the business. And now I'm like, what's the harm? Like, we're growing. I mean, if you have a real business and it's doing well, like, you really shouldn't be afraid to share high level metrics with people, because it will help you qualify it much more easily. And then if I'm talking to Jacobie, or I'm talking to Brooke, or I'm talking to you, Thibault, I can be a little more frontal with some of the basic metrics of my business. And then you'll be able to give me good referrals. Because at the end of the day, this is a networking game, and it's all the thing you're fighting against is time. So the most efficient you can be with your time, the better, which means like, updating your staff and your customers and your investors about what your goals are. That has been amazing for Hostfully. We've actually had staff members invest in the company. We've had customers invest in the company. We've had investors come out of the woodwork we didn't know existed, because we were being open about what our goals were. So if once you kind of get your house in order and you know what your focus areas are, sharing them with more people is always better. And so that's one thing I would love to pass on, especially I think to women. For some reason, I think there's like this fear of like maybe disappointment, or like I'm not doing enough, but like there's actually no benefit to being secretive about stuff. Like, just put it out there. And this is actually one of the reasons why I've invested in a couple of companies, because I love the founders and how frontal they are with where they are, and they don't try and sell. They're just very like reasonable with representing their current business and where they're headed. And I think it actually creates a lot of trust and credibility that will help you in the fundraising process.
So transparency to create trust in the fundraising process. That's a great approach. How about you, Jacobie, when it comes, for example, to finding buyers, investors? How would I go about it to get started again?
Yeah. Thank you. And I think Margot hit the nail on the head there with networking. Just get out there. We're an industry of entrepreneurs and hustlers and pirates. Like we're this cool new industry that we all got into before it was cool, or people are now getting into it now. And just ask around, open up, send us emails and ask our thoughts on things. Like from what I've gathered is that talking more, asking more questions, you're going to get more responses. So reach out and do that. Don't be afraid. Also, kind of stepping on that, go to conferences. We're having more and more conferences every year. Trust me, my wallet is feeling it. And they're geared towards new things that we're seeing. We just got back, Brooke and I just got back from one in Austin, and the audience was completely different than the traditional VRMA conferences. And there's just more and more being done. So you can kind of strategize and be like, okay, this one has a ton of private equity or venture-backed investors. Maybe I'll go here and try to schedule some meetings with them and converse. And on the flip side, if you are an investor or a buyer trying to get into the industry, once you've done your kind of your investment thesis to understand what market or what couple of markets you're interested in, fly or drive to those particular localized markets and reach out to the players in those markets, the operators, and see if you can take them out to dinner or lunch or coffee and have these conversations to learn more about them, tell them about your thoughts, and see if you might be able to start a long-term relationship.
That's a great point, Jacobie. And now we're going to take questions, because actually, and some questions I directly, directed to you. Sorry about my fumbling. So I will try to. So a lot of questions asked here. I'm going to read the questions, and whoever you can take the question is fantastic. Let me go through that because a lot of questions. All right. Ready? So any of you three, Margot, Brooke, or Jacobie, if you want to answer, just think, and then I will move on to the next question to be clear. All right, first one. We know that the value of PMCs has gone up over time, but is it simply because sales have gone up or because EBITDA multiples have increased?
Sorry, can you please repeat that?
Sure. Has the value gone up because either sales have gone up or because EBITDA multiples have increased?
I can take that for a second. I think it's a combination of both. Just in basic economics, supply demand, there are more buyers out there than ever before. So I don't think multiples are escalating at unreasonable numbers. However, we're seeing structures are being more seller friendly. And then obviously the majority of these companies had the best year financially speaking of their entire company's career in 2021. So it's just a function of you had your best year, your best last 12 months, and there's more buyers out there. So likely you're going to get a better price and better terms. In saying that, however, that is today's market. We have some large macroeconomic headwinds right in our face. And I know our industry is still doing fantastic, but I think there is some hesitation in the next 12 to 24 months to just be aware of. Like 2021 was incredible. And yeah, we'll see what the future holds.
Thanks, Jacobie. Different angle here, NFTs. So I'm thinking of setting up NFT ownerships of fractions of vacation homes. Any thoughts on the idea? NFT.
So it's basically like Picasso, but with NFTs.
I plan on acquiring a collection of homes to go into my brand. That's the idea. Any thoughts? If we don't, it's okay.
It reminds me of the companies that were doing like crypto, but for rentals. You know, like we saw like the B token. There were a couple of companies that did this. I think that this industry is just figuring itself out, and like adding another new financial instrument on top of it is like just adding complexity that is unnecessary, to be totally honest with you. It's not that I'm down on either on NFTs or crypto. It's just that like it's like new, adding new to new. Like who knows what's going to happen? Could be amazing, but probably not. That's my assessment.
Next question. Thank you, Margot. How do the ever-changing STR, STVR regulations impact the ability to sell? I mean, a resort community, Greater Palm Springs, where a measure is on the ballot November 22nd, to eliminate STR within 12 months in non-tourist commercial areas. So the influence, we talked about this already, I think, regulations on ability to sell. Who wants to take it?
Yeah, the truth is you can be regulated out of business. There's no sugarcoating that. And many companies in Oahu had that happen to them a couple of years ago or last year. So we did a deal in Palm Springs, I believe earlier this year, and it was a tough market to transact in. I'm not going to lie. So I would proactively talk to your councilmen and women.
But on the other side of it, I mean, you look at like San Diego, and look, there was some sales in that market, even though that market's been under regulation and the threat of regulation for a while. So it doesn't mean that you can't sell. It just means it's gonna make it a little bit more challenging, I assume.
Mm-hmm. Yeah, but at the very least, you should have a really good story about why you think it's gonna get better, right? So whether it's getting that information from the people on the ground.
Brooke, two questions for you. One, can you give us the name of the book you mentioned? I think it was the Blue Ocean book, right? What was it again?
Blue Ocean Strategy, yeah.
Yeah, Blue Ocean Strategy.
Also, the book behind him is fantastic.
Shameless plug.
Right. And second question for you, what data points do you use to identify B and C markets, Brooke?
Yeah, I don't know if there's any specific data points for that. It's more of just kind of understanding, the competitive landscape. So if I were doing an analysis and kind of going out there and looking to launch a company in kind of a secondary market, I would honestly just start with the OTAs, just look at how many different, properties are in each market, see how many different management companies are out there. I mean, we can do that with simple, I'm sure there's some companies out there that can do this research for you, but if I was just bootstrapped and doing it myself, I would simply just do a Google searches and just see how many management companies are out there and what the inventory looks like, and kind of start there and just kind of look at these markets, that are out there. But again, stay away. I would not launch personally. If I were launching a new company, I would go after a strategy on more of those secondary markets.
Okay. I guess that covers also the next question, which was, which are the top 5 markets where you would expand in B and C categories?
Yeah, I mean, just the ones I've seen a lot of success with, I kind of mentioned earlier, but again, like some of the drive to markets, West Virginia, so like a drive to from DC, Baltimore area. Like I said, even Arkansas has been doing really, really well. Texas Hill Country, Asheville, just some of these more.
Some of the areas in the Midwest too, right? Like in Wisconsin, Missouri, those are the C markets, right? I mean, I've also heard of really interesting stuff happening there too.
Yep.
Yeah, part of that, there's either no competition, or the competition that's there is typically, it could be like multi-generational and just very tech light. They don't have Hostfully's PMS, and that it could go for some tech enablement.
Well,
yeah.
on that note, we have a partner that acquired a company in West Virginia, and they virtually paid for the acquisition immediately by just kind of implementing some revenue management tools, some better marketing. I mean, so literally what they paid for this company ended up, by the increased ADR and increased margins, they paid for that acquisition. So if you go in and see it, they haven't been optimized, there's some good opportunities there too on an M&A basis.
Thank you. Jacobie, question for you. Because it has to do with stocks going down, but let's go. Public company valuations in the rental space have come down 75% since its highs last year. Vacasa minus 75%, Airbnb minus 60%, HomeToGo minus 60%, etc. Do you see similar valuation resets in your current deal flows, and to what extent?
Yeah, it's a good question, and part of this is just the public markets as a whole are down. I mean, you look at most companies out there, most of the big companies. I mean, we're on a Zoom meeting right now. It's probably down that same amount, if not 90% from their highs. Not to get into why everything was up so much, but the last, it just so happened that some of these companies went public kind of at the height of the market. So once again, the stock market it's a game, and it's short term, the fluctuations. So I wouldn't look at that as like hey, they've been public for 1 year, why are they down 70%? I'm sure if you go back and look at Amazon, it had tons of 70% swings on its way to grow thousands and thousands of multiples X. What we're seeing in the private markets is disconnected from that. We are still seeing valuations at a very healthy amount, like I said, because of the supply and demand of buyers, plus companies have had their best last 12 months.
Mm-hmm. Yeah, and I would also say that in early stage venture, also we're seeing valuations hold. Like, I mean, they're slightly depressed. Like they were outliers last year. The same thing as Jacobie said, but they were like in general, we're seeing like pre-seed, seed stage investments. The valuations are not that dissimilar than they would have been 12 months ago. I think that in software, we're a little more sensitive to the swings than in property management businesses. So just, you know, we're more sensitive, but I don't think that it's nowhere near the same level of sensitivity to the markets that people might be expecting. So that's a good thing. And then the follow-up question was really good too. What are the key metrics to keep the valuation up? I asked you, Jacobie.
Oh, yeah. I think that goes back to like getting your house in order. So if you keep showing growth in unit count and top line revenue and in bottom line profitability, that's always going to help for sure. And then every year looking back at your inventory and potentially culling the units that weren't profitable on a unit by unit basis is always a smart thing to do as well, and kind of clean up your portfolio each year on a year by year basis.
Continuing on this note, there's another question basically saying that, you know, so 2021 was super strong, then there's less revenue, which likely will continue through 2023. So are VC companies now looking at the future as a weaker VR future, and they're willing to offer less dollars? Seems like everyone is experienced less revenue this year nationwide. I'm not sure about that.
Yeah, I've seen a lot of, I think there are deals getting done in this industry quite healthfully. Just today, I heard about another one called My Place, which is a home sharing platform like Home Exchange that just raised a significant amount of money. It's funny, I don't actually feel like that's true. I think there are still deals getting done. I think overall in software, there's a lot less deals getting done, but in our specific neck of the woods, it's actually still pretty good. There's a lot of optimism about this market. And I think that there's also a good case that this market is counter-cyclical, so that even if we do enter a recession, that we'll be pretty protected because people still want to go on vacation. We proved that during COVID. I mean, people literally were like dying to go on vacation during COVID. So if they were dying to go on vacation during COVID, they can certainly like go during a recession. Maybe the prices will be slightly depressed, but people are not going to go out of business. I think that kind of commerce is still going to happen. So I don't believe that's necessarily true.
Well, just to kind of double click on that a little bit, you're right. In 2007, 2008, the worst recession we've ever seen in our generation, and many vacation rental managers were flat or even up slightly. So think about that. You know, when the entire market, we're about to drive off the proverbial cliff and we're flat and up a little bit. I mean, the worst I've heard when talking to somebody that's lived through this, they were down only 10% top line. So even if we, I think it's inevitable we're going into a recession or we're in a recession, but exactly what Margot just said, I think vacation rentals are, I don't want to say recession proof, but maybe recession insulated would probably be a good term for it.
You're on mute, Thibault.
Unmute, Thibault.
Perfect. Thank you. So I just say, we were running a bit of a time. I try to maybe 2 or 3 more minutes, and that's it, because I know you probably all have big meetings to attend things. But a question I have too, I had myself a bit linked to what we're discussing. So in a way, what we're saying that the multiples that are used to evaluate in the end, let's say smaller property management companies, are not the same ones that are being used like for the Vacasa and the rest, because they are, we talk about the decks and stuff there. So there are ways to calculate things, and obviously with the Vacasa stock going down, let's say 70%, you just wonder, whether these metrics, these the other one you should be using. So did I hear it correctly? I think Jacobie, that these are not the same things we're talking about. You should not be looking at these metrics. It's not like suddenly your own valuation is going down 70% as well. What do you think?
Yeah, I think always looking at kind of the big player and understanding their metrics is going to help, and see how that, because right now there's only a couple that are public. So our industry, that's kind of what most investors are looking at our industry as. So we are definitely connected in a sense there. But yeah, right now, the kind of small to medium-sized property management companies, their valuations are not exactly connected to a Vacasa or an Airbnb or something of that nature. And then obviously those companies aren't anywhere near each other either. But where like VC-backed companies and private equity-backed companies are, why they're interested in our industry and growing, is because there is this multiple expansion that you get from economies of scale. So whereas if you're like $1 million and less of EBITDA, you're probably going to be capped around a 5 multiple. You'll be in that like 3 to 5 multiple range. Whereas as that EBITDA grows, the multiples expand some, and obviously having growth showing and everything helps those multiples. And with VC-backed buyers, the same things, but they might be looking a little bit more at top line instead of bottom line.
Thank you for this answer. And last question is actually somebody has to sell a business to sell, and who should they contact and stuff. That's how we're going to end, right? In the end,
Jacobie. Call Jacobie.
To say exactly right. I want to say, like, if you obviously want to reach out to our speakers, today, Jacobie from C2G Advisors, or Margot for Hostfully, or Brooke from Vintory. Again, we'll put their contacts in the email you're going to get. I'm pretty sure they're easy to reach on LinkedIn, very approachable people. Thank you all for attending. I think we're like 7 minutes past, but we still have about 60 people attending. Thank you so much. Thank you again, the 3 of you, for your time today, for the insights. And really, to me, the call to action for everyone, we talked about networking, just reach out to any of us. If you have any question about buying, selling, investing in the market, fundraising, running a company as a woman. So we talk about different topics that are really, really relevant to us, I'm sure many of you. So do reach out. That's it for me. Thank you again, everyone, for attending today. If you could not attend the beginning, you get a recording by email. 3 speakers also kindly had discounts and offers for you guys. So you're going to get an email tomorrow, because for my time, it's late evening and I need to take care of the kids. And so you get the email tomorrow with the offers, how to redeem them, the contacts, everything you need. So thank you again all for attending. And I wish you a great day or great evening, wherever you are. Thank you all.
Thank you.
Thanks, everybody.